They manage institutional capital, pension funds, sovereign money, insurance reserves, retirement portfolios, massive ETF flows, the kind of money that moves markets just by breathing in a certain direction. So when BlackRock shifts from overweight to neutral on US equities, that matters. When they dial back on small caps, that matters. When they lean away from long duration bonds, that matters. And when their commentary starts smelling like stagflation, recession risk, and sector vulnerability, that really matters. Because BlackRock is not in the business of making you feel calm. They are in the business of preserving capital. That's it. That's the game. And when the biggest money manager on earth starts repositioning, you do not ask, what are they saying? You ask, what are they running from? And one of the biggest answers right now looks a lot like this, something we've been talking about for a while. Regional banks, banks that sit right in the blast radius of commercial real estate stress, local economic slowdown, and deposit nervousness. And that is where this whole thing starts getting ugly. Here's the number you need to understand. 875 billion. That is the amount of commercial real estate debt maturing in 2026. Office buildings, retail centers, hotels, commercial properties, all the stuff that looked amazing when money was cheap and everyone thought rates would stay low forever. And spoiler alert, they did not. Now, all that debt has to roll over into a world where financing is more expensive. Buildings are worth less. Occupancy is weaker. And the assumptions behind those loans look like they were made by a golden retriever wearing a tie. And regional banks? They're loaded with this stuff. Big diversified banks have commercial real estate exposure, sure. But regional banks are way more concentrated. In plain English, if this market gets ugly, they don't have as many ways to absorb the hit. They're local, they're concentrated, they're exposed. That's why this matters. They reached for yield. Safe assets weren't paying enough. Treasury yields were pathetic. The world was drunk on cheap money. So banks piled into commercial real estate because it looked solid. Buildings, collateral, cash flow. What could possibly go wrong?